So essentially all that, if the people have the information and they're able to actually access, because most of the companies when they start, it's like the 2-3 founders and they actually don't have enough working capital for them to actually survive. But there's government interventions already. And CETAs also do some, I think, on learnerships. They actually allow you to have the learners in your premises and then they pay for their salaries, their transport and the rest of it. So that's basically a way of, one, creating jobs and skills for the future, but also capacitating your business in terms of the number of hands that you have in it. But we don't benefit from that because we don't have information. So essentially by the time the business is big enough for a PE firm, they've struggled and have gone through sort of 40 years of the desert before they got to Canaan. So essentially that's where I think the gap is.
And speaking of that gap, from a litigation perspective, I think we are always coming into those instances where, as I think the synopsis sort of rightly pointed out, there's quite a lot of concerns about ownership, particularly when these enterprises are at that gap that you're talking about. So right before they get the funding, but where they're trying to sort of get the attention of, or rather get into that space. And so what do you have to say about that? And Terence, I'll put this to you, that those concerns about losing ownership or getting yourself into a really compromised or compromising position in terms of having to, quote unquote, I think they call it sell out. But what are your thoughts on that and how we can prevent sort of a preventative measure without, I think there was a complaint about too much regulation, of which I am in favor of, obviously. But what are your thoughts on regulation and sort of preventing that exploitation at that really crucial point?
I think it's a real concern. So we've spoken about the skills gap, we've spoken about the lack of infrastructure in a business to really provide proper advice and to be able to structure things correctly. And if you do have an angel funder, be that an IDC, not many people would think of the IDC as an angel, but very often they do an angel funding type function, or private entrepreneurs that provide that funding, they are taking the risk. And so they expect to get their pound of flesh. Now that can be abused. And there's obviously consideration. But I think as Exponent, from our perspective, we always try to look at a combination of credit and equity so that you both have skin in the game. You don't necessarily look at it entirely as a pure equity play. The reality is we're sitting here and the audience is a sophisticated audience. When we look at SMEs, 80% of the SMEs are really well below that waterline from a skills, infrastructure, and development point of view. And the key for us is to make sure that below the waterline population is actually raised, because that's the feeder to your middle-sized operations. Those are the kinds of operations that you're talking about that you can start talking on a PE or a VC type basis.
So what are the merits, you think, of funds versus deal-by-deal investments? And the challenges in securing capital in today's environment?
Yeah, first, Mr. Matongo was my father. I'm Lana.
So your father was supposed to be there?
Yeah, my father. But I think one of the things is, presently in the current environment, I think what we notice from what's happening is that a lot of the current investors find themselves in a situation where lines of capital are rather thin. And a lot of the investors who you'd identify are also hamstrung by regulation in terms of the extent to which they can make investments. That would mostly apply to, say, for example, banking institutions and Basel and credit control and all that stuff. So their ability then to implement the investments that need to be made into these smaller businesses that, as you rightfully said, in many instances are not yet as investment ready as they would like for their appetite. They don't have the levels of collateral and so on and so on. What that then does is when you enter into the fund management space and you allocate the resources, there are two things that it does firstly for an investor. One, it shortens the lead time between starting the execution and actually deploying the capital, because you don't have to then package the deal, finish, and then go and see which of the funders is interested in putting it together, and then negotiating a second set of terms in terms of what does your fund actually want. You've gone through the process, you've got the kitty, and now what you're saying is, let me find the opportunities and match them with the capital that I've raised. And I think that in of itself is also going to be a big stimulator for me for where the economy needs to get growth from.